So I'm looking forward to hearing more about it. Yeah.
Fantastic.
Thank you for sharing your insights.
Yeah.
Again,
That's
thank you,
absolutely
Inma,
great.
for
I'm very,
joining us.
I mean, I've known Rick for a little bit, and we're both obviously very passionate about sustainability. So I've had now the chance to apply to my favorite sector, which is finance. So I'm very pleased. I developed a new course for my university this term. So it's all about sustainable finance and regulation there. So
excellent. Okay, well, it's
Excellent,
1 past
excellent.
1. Yeah, again, it's great to have colleagues joining us, not only students. So again, thanks to Plamen. As we begin, I'm just going to run through a few things because we've been running the Prime Impact Speaker series for some time, really. Definitely 1 year at Middlesex, but before this, I was hosting this at Winchester. But we do have students joining us from our overseas campuses in Dubai, Mauritius, and Austria today, as I understood from a communication earlier via email. So I'm going to start the session by, first of all, welcoming our speaker today, Inma, who has joined us from Richmond, American University, London. For those who have attended the previous Prime Impact speaker series, just a recap, we had Mr. David Anderson from the University of Lincoln 2 weeks ago. David is the winner of the Prime UK and Ireland Seed Funding Competition, the previous round, as he mentioned. Again, as a recap, David talked about 4 interactive card games that he designed to make sustainability education both meaningful and memorable. So we had a really good 2 hours long workshop. We had some really good feedback that looked at the 17 Sustainable Development Goals memory game. Then we talked about Sustainable Development Trumps, which was a trick-taking game. We had Cards for Sustainability and Concord. So that was extremely well attended. So thank you for everybody who attended that particular session. Today, I've got the pleasure to introduce Ms. Inma Ramos Perez from, again, Richmond, American University, London. She holds a double first degree in law and business. She's got a master's at LSE on international business law. Inma's expertise resides on her in-depth knowledge of international financial markets and international business environment through her 2 decades as an investment banker, particularly in the fields of corporate finance and international capital issuance through listings in the major international stock exchanges. As I mentioned in my email as well, Inma is also the co-lead for the Prime Chapter UK and Ireland, London and Southeast Group. And she truly brings a rare blend of academic insight and professional expertise to her work. I have attended Inma sessions in the past. They tend to be informative, insightful, immersive, and also supportive. So I'm very much looking forward to the session on the financial value chain and its influence on sustainability. Think twice. Maybe a few more times. We'll see by the time we get to the end. So Inma, over to you, and thank you.
Okay.
Welcome to
Thank you very
Middlesex.
much, Rick. It's a pleasure to be here. Thank you very much for the invitation. Thank you for you all to be with me for 1 hour in this after lunch hour. So I hope you don't go heavily sleepy. I'll make sure you don't. So I'm going to really give you an insight of sustainability and finance. And I don't know how much finance you know. I don't know how much sustainability you know. I'm going to assume you know very little or near to nothing. So I'm going to just build everything pretty much from scratch. Okay. So what's the big deal here? What's the importance? So by now, probably most of you are aware what sustainability is. So sustainability is about looking at the impact of organizations, and I'm going to be on the business world for the purpose of this conversation with you today. So in the business world, we're looking at the impact of organizations, companies, multinationals on economy, people, and planet. I'm sure you've come across this concept before. Now, finance, and suddenly you might think, well, you know, I have an account. Most of you will have an account, if not everyone. I mean, do banks pollute? Do banks really have an impact on the environment? And then do banks have something to do with supply chains we've learned in other courses? Do they have anything to do with biodiversity? So suddenly you just think, okay, I know sustainability, but you know, probably has to do with fashion companies, cocoa companies, coffee companies, you know, kind of things that we kind of associate much more into sustainability. But what about finance? And you say, well, that doesn't really. Well, this is about part of my discussion today, thinking twice. Well, finance has an incredible role on sustainability, and I hope to convince you about it and teach you a little bit or share some of the important points to learn about it. Well, you know, what do banks do? Banks lend money, investors invest money, and they invest money in companies, okay? Companies that might pollute or not pollute, companies that might be more sustainable or less sustainable. So this is what we're going to talk about it. So for me, finance and the financial sector is really the influencer of sustainability. So, you know, we're used to the influencer concept in this time and age related to marketing. I think finance and the role of banks and investors is the one of being influencers on sustainability. And this is what we're going to talk about. So I've just thrown at you different players on the what I call the financial value chain. So at the moment, they are not in order. You might be more or less aware about them. You know, you have corporates, you have asset managers, you have insurers, advisors, index rating companies, proxy advisors. Well, this is overwhelming, isn't it? So how do all come together, and how do they maybe have a real impact on sustainability? And at the end of the presentation today, you might be thinking twice about the bank in which you have your money and whether you want them or you know about their role in sustainability. Okay, so I'm going to put this together. I mean, if we were maybe in person, I would ask you more direct questions. That's why I like how I like teaching. But I'm going to keep it to rhetoric questions. But you might be thinking about them, or you might be thinking, sorry, my earphone has dropped. Or you might be thinking about questions on, to ask me at the end. Okay, so let's start putting some of these players together, and let's start putting the relationship and how this is important. See if you can make sense of it. And please challenge me at the end if something doesn't make sense. So we have at the very left, we have asset owners. Who are asset owners? Those that have money. I mean, we're talking about money here. So it could be small savers, maybe you and me, put a little bit of money on the side, or it could be pension funds. As you know, pension funds, what are they? They are pots of money that are put aside during our working life to hopefully have a happy retirement in which we don't have to worry about having to earn money. So those are pots of money, and those are called in the finance world, they're called asset owners. Okay. So the asset owners have that money. If you know anything basic on finance, is that money in cash does not produce anything. It might be safer, and sometimes people prefer to have the money under their mattress because they don't trust their bank. I hope it's not the case here. So you decide to actually put it to work, and put it to work is to make it grow. So you could put some money into bank as a deposit, or you could put money to invest maybe in the stock exchange. I mean, more and more students like you invest in stocks. It's become more accessible through apps, etc. But you can maybe say, well, I'm going to put it to an asset manager. Also, the pension funds, this big pot of money, you are hoping that even when you or your employer put some money aside during your working life, you hope that at the end that mass has increased a little bit because there's been managers, and those are called asset managers, that actually have invested that money wisely. So in fact, it's grown by the time you retire. So we do have intermediaries here, and they're called advisors or consultants. That's a very well known, and it's not consultants in the general sense. They have a specific financial meaning that they help, for instance, pension funds to decide which asset managers are the right ones in order to invest money. Okay, so you have money with the asset managers or with the banks. Where do they put that money? So asset managers will invest money on companies. Okay, and that is for me the most important way to force a company to behave in a certain way. So when corporates decide to be sustainable, or perhaps they say they're sustainable, asset managers are going to check that out. Okay, so they are going to be looking at their accounts, looking at their reports, and I'll talk a little bit about it. So that's how the money moves. So you have asset owners that put their money in asset managers or in banks, and asset managers could be investing in corporates, in companies. Banks could be lending money. Okay, so the financial sector is really enabling, facilitating those flows of money. And in the middle of these flows of money, you have other players. So you have advisors and consultants. And as I said before, consultants has a really specific meaning in the financial world. They are the ones that very often assist pension funds to decide what asset managers they are going to go for, depending on their investment philosophy. And asset managers, when they decide in which corporates they are going to invest, and I'm going to give you a few numbers now soon, they often, when they want to maybe invest on a sustainable company, they often don't have the resources to actually go to each and every annual report. And I would like you to, just for curiosity, after this this presentation, that you go to the annual report or sustainability report of a couple of big listed companies. Have a look at them. They are enormous. They can be 400 pages very easily. Maybe you know which is the big asset manager in the world. If not, I'm going to tell you, BlackRock. And what are the assets under management? So it's about 10 trillion, okay? So 10 trillion, if you can imagine the number, is quite difficult. They have $10 trillion invested in companies around the world. And these companies are in the thousands. So at the time of actually making a decision of investment, they don't have the resources to go through the 400-page sustainability report and decide on one by one how they're going to invest. Okay, here comes welcome more intermediaries. I'll talk a little bit about them. So they are rating and ranking agencies. And of course, they're saying that when we go to a restaurant, very often we see, oh, well, let's look at the rating of that restaurant. That's what asset managers do. A little bit lazy, in my opinion, but that's what they do. They look at rating agencies that actually rate sustainability, and they then decide which corporates they're going to go for. And well, I'll talk about proxy advisors in a minute, but you might know that when you are a shareholder of a company, maybe some of you are shareholders in companies, you are invited once a year to actually vote on corporate matters. Again, asset managers don't have the resources to look at all the agendas of all the annual meetings of the thousands of companies in which they invest, and they employ proxy advisors, other intermediaries here. We do have insurers and reinsurers. What do? They make sure that if corporates incur on some liabilities or losses, they cover them. Insurers are big investors as well, because they do have large pots of money through the insurance premium, okay? And they obviously need to manage it to have enough when disasters occur. Another thing I wanted to actually say and use this presentation is maybe some of you are interested in finance in the future. And as I have many of my students do, and you just think, okay, I'm going to apply to banks. I hope with this slide, you also can think about other financial players. Actually, some of them are very big, be proxy advisors, be rating agencies, rankings. They do give you a nice entry into the financial world as well, if you're interested for career purposes. So I always like to embed some employability into my teaching. Okay, so I hope you've understood this general overview of the flow of money, how it goes from asset owners to investors and then to companies. So I'm going to break it in really two flows of money: an investment and lending as the basic ones. Of course, there are many more others. So investing in sustainable companies. So how does that happen? Actually, there are really two approaches. They have been evolving. So I'm going to give you a little bit of how that happens in the real world. So, and I just realized of a typo, which you never see unless you present, I guess, in the negative screening. There's an E missing, apologies. So initially, most of the investors were not really that sophisticated in terms of investing on sustainable companies. I mean, even what is a sustainable company? There are frameworks, there are indicators, there are metrics. Is still very varied and quite complex. So they decide to say, well, I'm going to take a simplistic view on investing in sustainable companies. I'm going to have what they call an exclusionary negative screening. So everything is good apart from, I'm not going to invest in, I don't know, defense companies, tobacco companies, alcoholic beverages companies. So quite simple. I would maybe exclude some countries because they are on severe conflict, so they have governments that are perceived to be absolute or oppressing of human rights. Some investors will have a certain beliefs or ethical aims, and that will guide their investment. But it was quite simple and in general quite exclusionary. So I'm going to exclude these sectors or stocks. Okay, so that's the initial approach that investors took to sustainability. If we move forward, and with the increase, obviously, use of technology, analytics, big data, etc., investors got into more an inclusionary approach to that. So they actually embed sustainability into their analysis. And if your finance students, you've done maybe some corporate finance and you've learned about valuation of companies, you will know that one of the methods to value companies, one of the traditional methods, is through discounted cash flow. So a discounted cash flow really includes projecting a profit and loss account and discounting that value to the present. So what investors are then doing to embed sustainability, they will put an impact on the growth of earnings, on the cost of capital, etc., to embed factors of sustainability on the actual financial valuation. Okay. So really to integrate sustainability on their valuation. And sometimes you see graphs where you have, okay, this is the valuation of the company, and then they do what they call sustainability tilt. So they upgrade or downgrade the valuation depending on some sustainability parameters, which could be environmental, or they could be obviously social. So this is what I'm explaining here. So investors, much more, they have a financial valuation and is adjusted upwards or downwards. That's what's called a tilt, based on sustainability aspects. Now, I'm going to talk a little bit about data. So you would say, okay, yes, I've learned about finance. I know how to value companies, but what is this sustainability data? How are they going to really impact finance? So quite simply, and this is really the exciting part of sustainable finance, we've got to identify some data, some metrics that, although they are not strictly financials, they are not sales, they are no cost, they are no tax, they do have a financial impact. So they are financially material. So this is where finance meets sustainability. I'm going to give you a couple of examples. Imagine that a company is subject to data breaches. Okay, so you would say, well, that is a legal risk. They might have to pay fines to the ICO, to the Information Commissioner Officer, which is the entity in the UK looking after the data protection. So if you need to, if you have data breaches and you incur obviously on a certain liability for that, guess what? Your cost increases, your profit decreases. Okay, so and what are you, if you're familiar with SDGs, maybe you're reaching SDG 3 on health and well-being. You are putting in danger well-being of your customers when there is a data breach that maybe you did not consider, you didn't have adequate protection systems, etc. What about things such as work accidents? If you don't have a healthy and safe working environment, maybe there are more accidents or near misses. If you report those and financial analysts look at those, they might tilt downwards their valuation. Okay, so we have by now identified quite a lot of data metrics which are sustainability related, but they do have a material financial impact. If you want to know more about them, I would advise you to search for SASB. SASB are the current most recognized frameworks on reporting financially material sustainability metrics. Okay, so by now, in an integrated manner, as you can see at the bottom of this slide, both financial and non-financial data are really the basis of investment decisions, okay? Because investors have realized that it's not business as usual anymore. And I'll talk a little bit of what I mean by that. So let's zooming into these investors once again. So we have the asset managers on which maybe we have put our small savings. So we have the BlackRocks of this world, the Vanguard, the Goldman Sachs Asset Management, managing billions or trillions of our small savings. Now, how do they actually invest? Okay, there are two ways of investing. Some investors are active. So what do? Well, I like Coca-Cola because I've looked at Coca-Cola. I look at its prospects, growth, sector overview, whatever. I like it. I buy Coca-Cola. I like NVIDIA, and I'm sure many of you do, especially after yesterday's results. You say, well, I like NVIDIA. I believe that their position is so strong on these graphic chips that enable AI that I'm still going for it. Okay, so you might pick up companies in which you invest. That's what's called active investment. But I have to say, most of the investment in this world is not active, because investors have to perform. They have to tell us at the end of the year, to us, the small savers, how they have managed. They don't want to risk getting it wrong with few stocks here and there. So what they do is what is called passive investment. So let's say they say, well, I invest in the UK, in the London Stock Exchange. I invest in New York. I invest in Amsterdam, or I invest in companies in this sector. So there are other companies which are called index companies that create an index. So if you're familiar with investment in the UK, you might be familiar with the FTSE 100. So the FTSE 100 represents the top 100 companies in the UK. So a passive investment will be, well, look, I'm investing in the FTSE 100. So in my portfolio of investment, I'm going to replicate the FTSE 100 index. So therefore, at the end of the year, I would have performed in line with the London Stock Exchange. Why? Because I do have those companies in my portfolio. Okay, so I don't have to take individual decisions whether I like this company more than the other. I just take an overall decision on a market or a sector. Okay, so how do I decide? How I know which companies are in that market? Because they are the so-called index companies that create the FTSE 100. Okay, so when you look at FTSE 100 as an
Inma, sorry, you got muted for some reason. Oh, only lost you for 4 seconds, so you don't have to go back far. Yeah, you're back now.
Can you hear me now?
Yeah.
Okay, it must have been.
Not sure what happened. Yeah.
Sorry, it's maybe my hands moving around and my screen being very sensitive. Apologies. Okay, so most of the investors will take what is called a passive investment approach, i.e., they don't choose, I want this company over this one. They just say, I choose an index, and whatever companies are in that index are the ones in which I'm going to invest. Now, who creates indices? They don't appear magically. Even if you are used to the Dow Jones, to the S&P 500, these are companies behind that. They are index companies that create these indices in which we invest, or that the asset managers invest. So they say, well, I'm investing on the S&P 500. That means my portfolio, my investment replicates, copies the companies that are on the S&P 500. I do FTSE 100, I replicate that. Now, the interesting thing is that now we have sustainability indices. So you might want to invest, instead of the FTSE 100, which is simply the biggest 100 companies in the UK, you might want to invest in FTSE for Good. And that is an index created by the FTSE company, which embeds the top sustainability companies in the UK. Now, how do those index companies select which companies to embed there? And you can understand how important that is, because if your company is in an index, is going to be a recipient of passive investment. Okay, so they do it by getting, obviously, the data from the company, and therefore companies are really positively motivated to include as many data and disclosure and certifications to be able to be part of that index. So again, this is so exciting because it's where sustainability meets money, okay? And you would say, okay, so why these asset managers are so interested in investing instead of FTSE 100, FTSE for Good 100, which is the top sustainability companies in the London Stock Exchange. The why is at the bottom of this page. It's a funny word. You might not be familiar with it. It's stewardship. Stewardship has, again, a clear financial meaning. It's a technical word, which means that asset managers, funds in which we invest our money, they need at the end of the year to produce a report which is public, and you could maybe try after this presentation, if you put a stewardship report and an asset manager of that you might like or know, you will see how they need to report to us, because at the end it's our money that we've trusted in an asset manager, how they have invested it in sustainable companies, how they have chosen them to actually make sure they are impactful companies in social, environmental, and governance areas. So that justifies the existence of these rating companies and index companies. So obviously, investors are going to follow what rating companies are telling them, and the rating sometimes is a little bit like grades. They rate companies between A and F. So do you have an A or a B or a C in terms of sustainability? So this makes the sustainability investment chain, as I would call it. So you can imagine that companies are really interested in obviously having capital invested in them. They know they won't get that unless they are rated favorably, unless their name is in an index. And for that, they will need to produce data, which not only they just create themselves, but very often they need to be audited, so that index and rating companies include them, and therefore asset managers are going to direct their money there. Another word I want to share with you on proxy advisors. Again, who are these? So one thing is what investors will do at the time of investing. So they're going to decide, well, oh, this company is part of FTSE for Good, or Dow Jones Sustainability Index, or S&P Sustainability. So I'm going to invest there. Great. But also, asset managers have an obligation, which is called engagement. So during the time that they are investors, they need to engage with companies. What does that mean? Talk to companies so they can access them through their investor relations or through their CFO to actually prompt them on certain aspects on sustainability. Also, once a year, asset managers or whoever is the owner of a company, they are invited to an annual general meeting. You might know it from other courses. And on that annual general meeting, if you're a shareholder, you can vote. And there are more and more social and environmental issues in the agenda on which investors, shareholders vote. Once again, big asset managers don't have the capability to actually be part of an individual analysis of each and every annual meeting. So they engage intermediaries, and they are called proxy advisors that produce reports advising to vote in favor or against in each annual general meeting. So you can see how this flow of money, which is not just me, a small saver, to the asset manager, an asset manager to company, it just flows so easily. But we do have a number of other intermediaries. And once again, if any of you is really keen on this area of sustainable finance, think not only about asset managers, but also think of index and rating companies. So the FTSEs, the Analytical, the Morningstar, the Bloomberg, the Dow Jones, the S&Ps, they all are as well index and rating companies, which are now evolving to embed sustainability. Proxy advisors, you have ISS, Glass Lewis. These are big proxy advisors. They do produce reports, analysis of annual general meetings for the benefit of asset managers. And for you listening to me today, it also could be an entry into the financial system, if that's what maybe you are exploring for future professional career. So I talked about investment. Now I want to talk a little bit about borrowing and lending. So obviously that comes from banks, no longer from investors in a way, but I'll talk about it. So everybody will know what is lending and borrowing. So banks lend in corporates, okay? And you would say, well, what do banks do to decide whether they will lend to someone? Very simple. When you apply for a mortgage, they will look at your earnings. Do you have a stable job? What is the value of your house? Are they going to get paid back? Okay, so that's the typical thing that a bank will look when they lend to us. When they lend to corporates, they also look at their financial stability, but more and more they're going to look at how sustainable that corporate is. Why? Because banks need now to report in what is called financed emissions. So I'm going to talk a little bit about CO2 and greenhouse gases. And probably most of you know what they are. So greenhouse gases are a bunch of gases. So for those that maybe like chemistry will know much more than me. So these greenhouse gases, which in principle are great to keep us somehow warm, especially in a day like today, in excess, they contribute to global warming. Now, if banks finance or lend to companies that emit greenhouse gases, when they report what we call a scope 3 emissions, so emissions that are not produced by us. I mean, banks do not burn coal themselves or fossil fuels in their premises. You go to a bank, you just see a bunch of people pretty much providing a service. So often we don't associate banks with emissions or pollution, but they do pollute indirectly if they are financing, if they are lending money to companies that pollute, okay? So that's where sustainability and lending becomes together, okay? Second, corporates, they might borrow money, not only from banks, but also from investors. And how do they borrow money from investors? Through bonds. So bonds are loans, but instead of given by a bank, they're given by investors in a smaller denomination. So banks might be able to lend in the billions, but you might borrow from investors in when you might split the 1 billion in $50,000 or pounds denominations and break it down among a bunch of investors. Okay, so investors as well lending money to corporates through bonds will have to as well reflect whether they are lending that money to corporates that pollute, or maybe they have a negative social impact through their supply chains, etc. So that's where borrowing links with sustainability. Both banks and investors, when they report their emissions, obviously they don't burn fossil fuels themselves, but they might burn fossil fuels indirectly through the companies to whom they lend, through the companies to whom they buy their bonds. So that's what is called, and it's at the bottom of this slide, financed emissions, okay? And these will be finance emissions, and they will be a scope 3. And these are a technical protocol, which you can learn more about if you go to the greenhouse gas protocol that defines the scopes of emissions. Scope 1 are direct emissions. So if I'm burning fossil fuel myself in my manufacturing, that's scope 1 emissions. Scope 2 emissions are the ones that are somehow indirect through the energy that I consume. So if the energy that I consume comes from fossil fuels, that will qualify as a scope 2 emission, and a scope 3 are indirect, more indirect. And in the case of the financial system, it includes the emissions of the companies to whom banks or investors lend money or invest into. Okay, so this is something that maybe escapes most of you at the beginning of this presentation. I hope is crystal clear by now. So I'm kind of coming from the detail to the big overall picture. So what is sustainable finance is two things. Is sustainable financial institutions. So basically, when you look at what investors do and how investors invest, or what banks do and how they do what they do, i.e. lending and investors investing, are they doing it in a sustainable manner? And in a sustainable manner, it means, are they investing in sustainable companies? Are they lending to sustainable companies? And there are other aspects as well about their operations, how they are obviously treating their employees, issues on remuneration, issues on governance, etc. But also it's about sustainable financial products. And maybe you don't know what these are, but there is now an array of financial products which embed sustainability right from the beginning. I'm going to give you some examples. So we do have now something that's called green bonds. So green bonds are borrowings. We said that bonds was a type of borrowing that companies can do from investors, but they are committed to use that money on a green venture, i.e., look, I want to borrow money from you investors, I want to issue bonds, and the proceeds of that money, I'm going to invest it in developing, renewable energy plant. Okay, so when the actual aim of a finance is something that is environmentally as its aim, often has the green, sustainable name in front. So we do have now a growing market of green bonds, blue bonds. So blue bonds are borrowings that are used to develop marine resources in a sustainable manner. We do have social bonds, when, for instance, you can raise funds or borrow money that you're going to use to improve livelihood on your supply chain, on your employees, on local communities, etc. We start having green mortgages. So we start seeing that when we borrow money to buy our property, and that's probably the biggest financial decision we tend to have in our lifetime, how energy efficient is our home? Because the more energy efficient it is, the lower the cost of our mortgage is going to be. So those are financial products that are being developed. It's a growing market to obviously support sustainability as well. So you will now wonder yourself, is the financial sector altruist? Do they do it because they believe that this is the right thing? I hope yes, but my answer is no. I just assume that the overall motive might be financial return. But there is another motive which is really important, which is sustainability is a source of risk that needs to be managed. If you don't believe me, look at any annual report of any large listed company, look at the risk section, and you will see how many climate, biodiversity, and pollution risks they start mentioning that's going to have an impact on their accounts. So I've just put here 3 examples of risk. So even from the risk management perspective, being sustainable pays off. So physical risk, imagine you are a hotel company, you are very close to the sea level is rising, and you need to build sea defenses. Otherwise, you might actually be hit in your premises, in your buildings. So that's a risk for the company. If I'm a bank lending money to that company, and that company might not be doing well because of physical risk caused by climate change, I might not get paid back. So that's a risk, that's a credit risk for me as a bank. There could be a transition risk. We do have more and more legislation in which we are aiming to get to a net zero, and you just have to look at the different programs by different governments. So that will maybe change and create a risk if you are very dependent on fossil fuels. So that again might have an impact on those that lend money to you. A legal risk. We do have more and more environmental legislation that is related to supply chains, to deforestation, to waste management. Breaching those regulations might get you as a corporate into trouble. Again, if you are the bank that's lending to a company that is getting fines because they are not meeting the environmental standards, your lending is at risk. If you're an investor investing in a company that is subject to these risks, that risk is embedded in your investment as well. And your investment might not be doing as good as it would have been initially expected. So I want to conclude this with really a more personal question to you. So you might want to start thinking, okay, what is my banking or investment profile? So you might be, and I put here the shades of green, really. I want my bank or investment fund to be complying with regulations. Okay, so fine, tick the box, look whether there's any litigation, go to FCA. FCA is the financial regulator in the UK. It has a beautiful section on fines on the website. So I'm happy if my bank just complies. Do I want my bank to be more impactful? Check their reporting. I've put here a couple of words which might not mean a lot to you, but I've put you links at the end if you want to explore them further. One is TCFD. So do I see whether my bank is reporting on climate impact? Are they reporting on the financed emissions? Are they reporting on any transition plan to have a net zero? Are they having any climate strategy? So you might want to look now, probably you never thought it could be impactful on your banking decision, to have a look at how they care about climate and other sustainability matters, and not only because it might look good and be fashionable, but also because they are then diminishing a very considerable financial risk. Finally, you might just want your bank to go ahead of others, So not only you want to see their reporting on climate and emissions, but you want to see that they are actually at the forefront of maybe green, blue, social bonds, green mortgages, green bonds. And even more, the ultimate check is, do they have an integrated report? Very often, companies have a financial report, okay? That's for accountants, that's for shareholders, and a sustainability report, okay? A nice one for employees, for customers. Do they put them all together? Because at the end of the day, sustainability has a financial impact. Do they believe that they should integrate finance and non-finance together? So for me, banks that integrate, and you have a number of banks that produce integrated reports, they are showing us their belief on embedding sustainability into finance. So I put you at the end a couple of links. So in terms of sustainability, what is the ultimate frontier? Climate change is quite well understood, quite well embedded. Everybody knows about emissions, financed emissions for banks and financed emissions for investments are also well understood. What we're looking at now is nature impact. That would take me few other presentations to explain about it, but guess what? There is now a new framework and there's a strong recognition, and you can see it in a lot of annual reports by banks, that nature has an impact on finance, on the money that you might make, on the risks that your business is up to. And this framework is called TCND. I've put the links at the end. Is really fascinating. Both TCFD and TCND have fantastic websites with a lot of training and educational material if any of you want to go further into that. So that's all I had for you today. I could go for hours and hours. It's one of my passion topics, but I'm open to questions if you have any. Thank you.
Fantastic. Thank you so much, Irma. That was a very clear, detailed, fantastic
I can't hear you, Rick.
Oh. Can you hear me now? Hello?
Now I can hear you.
You can hear me now. So I was just saying, just to go back, fantastic, really good examples, very clear explanation of some of the quite complex sort of concepts, and especially when organizations are actually reporting on some of these matters, not when we're reading them, but when they're crafting and curating them. Curating is probably a dangerous word in this context, but it was quite clear, particularly the interplay between concepts. I think I'm sort of hopeful that a majority of our MBA students who joined us today, executive MBA and general MBA students, benefited from some of these concepts. As you were presenting, I added some readings on the chat, so sort of a top-up, catch-up readings. Okay, I'm conscious of the time. Just gonna open the floor to questions. But George, would you mind introducing yourself very quickly, and perhaps you could facilitate the Q&A together. George is one of our MBA students. George, can you hear me? Hi, George.
Yes, Rick. Hi, Rick. I can hear you. Can you hear me?
Yes, we can see.
Yes, I can hear you. If you can speak up a little bit, put my speaker on maximum.
Okay, yes. Very, very interesting session because interestingly, as Rick said, we are currently on the finance and economics module, and in class we have discussed about investments and the FT 100 and 250, then also the S&P 500. So a couple of things that piqued my interest here was in respect to the greenwashing and also retail investors. Retail investors seems to be the people we do not look at, but are really impactful in the market. We saw what happened to GameStop, the stock recently, not so recently, but where retail investors, took the price of that particular stock ridiculously high, and also we've seen the impact of retail investors in the market. So are we looking at any, is there currently, any way to hold the retail investors accountable for the investments they make? So if retail investors hold about 25% of assets in the UK and over 80% of assets in the US, that's a lot of market power they have. Is there any way, or are we even looking at it in the future, to hold these retail investors, me, you, my colleagues who all have access to, exchange apps like eToro and co, that you can just go online and buy whatever stock you want to buy? Is there how we can even be directed in the right path to look at green indexes and make sure we invest in them, or even being held accountable for the investments we make that are adverse to the environment?
Good question, George. Thanks for that. Yeah, that's a really good question to start with, and then we can take some more. Inma, do you want to take some more questions and answer them together, or would you like to go with George first? Yeah, okay. So George, we'll get back to the question because that's a really good discussion I also would like to see happen. Anybody else? Do you have any questions? When I say anybody else, I'm looking at students who do not have lessons from 2 p.m. onwards. If you do have lessons from 2 p.m. onwards, please start moving to the classroom. Others, you don't have lessons at 2 o'clock. Questions, thoughts for Inma? Please drop it in the chat if that's easier, or I suppose George has inspired us. Inma, let's start with... Oh, hi. Hi, Amanda.
Good afternoon, Dr. Rick. Good afternoon, Inma. Thank you, everyone. And thank you, Inma, for the very insightful and very informative session this afternoon. Thank you. I learned a lot. Take care, everyone. Have a nice day.
Thank you, Amanda. Glad you could join us. Very good. Okay, Inma, do you want to...
yeah, I can go quickly. Retail investors, the way they are viewed from a financial perspective, they are more from a not to be held accountable. Obviously their decisions are quite independent from each other. That's the theory. They are more, they're viewed from a regulatory perspective, they're mainly viewed as being protected. So that's why, for instance, in terms, if you are a retail investor and you want to go more towards the sustainability area, there's more regulations. For instance, the FCA developed something a couple of years ago in terms of labeling of funds and investments from the sustainability perspective. The EU as well. So you no longer can call a fund as sustainable if it does not meet certain regulatory criteria. Because obviously, at the same time, we're seeing greenwashing in products that we can touch and feel. There's been greenwashing about portraying certain investment as sustainable or green or social. So that's really the only perspective I can see that is relevant from the regulatory path in terms of investment by retail. I agree, the retail has grown quite a lot. As you say, George, enabled by all these platforms that make it more accessible. Retail is not a professional investor. So, their investment is pretty much as a gamble more than anything else. And probably there are enough disclaimers when you go to these apps in terms of obviously investing and knowing that you can actually lose your capital. There's no guaranteed capital. So the only extra information you can have is the regulatory framework that is being developed about labeling investments, that there is one in place both in the UK and in the EU, and also in terms of regulating the platforms, regulating the index providers and the rating companies. So that's what you're trusting on, so that the information you access is coming from the right source, is verified and is regulated. But otherwise, it's a risk. It's a big risk as a retail to invest. There's something. There's no way around that.
Yeah. No, it's very sector specific questions, and I think it's really critical that we address question sector specific, because some of these reports, as we know, from the reports that we have to produce and look at, they're not super specific. There's sort of a certain openness that also makes them quite vulnerable in that regard. Just a quick not really notification, but I've just added 2 readings on greenwashing, because at one point, I noticed you said different shades of green, and there's like this the 7 shades of greenwashing. If you are interested, please do read the last 2 readings that I added. This is one of the articles that I published in 2020, maybe. It's called CSR: The Good, the Bad, and the Greenwashing. No pun intended there, but I've got one question, but George, again, happy to sort of take more if you have some. Also, you've got 40 plus students who are still with us. Please do ask away. This question I would like to frame in a certain way, Inma. So if students who are, or sort of graduates tomorrow, who are joining this particular industry, the green industry, let's say, and they are asked, let's say, how do you evaluate the financial return of decarbonization projects? Now, there's a number of ways you could answer that, but how should they approach this particular question in a way that certain stakeholders do not get immediately upset? Because that's a concern that we maintain all the time.
Yeah, I would say, I mean, some companies start already implementing carbon accounting as part of, their financial in preparation for a transition into a carbon zero. So I think is to do with the issue of externalities. As you know, companies have been polluting, companies have been throwing waste. That's never been reflected. They've never paid for that. So we are moving to obviously a model with the extended producer responsibility, with the polluter pays principle, to embed, internalize that cost that companies were causing to the environment, but it was not their cost. It was everybody else's cost. So I think the preparation for decarbonization is to assign a cost to carbon in preparation for that. That's in a way, in a more numeric way. And for me, numbers sometimes are a little bit more concrete than just big declarations and strategic plans, to really put in numbers what that would mean for you. I mean, there are obviously other mechanisms such as, in the financial world, you have ETSs, or emissions trading systems. So there is a way to start monetizing the cost and the benefit of a sustainability route. So that's how I see it at the moment. And again, just talking about my presentation, I don't expect students to have understood 100%, but hopefully it's given a feeling of what is out there and how massive it is, and maybe open up their interest and excitement for sustainable finance.
No, absolutely. I mean, that's what we do when you've got advanced learners. And I've always, said this before, and students who are with us know this quite well. MBA is an applied degree. So it is quite essential to look for those pointers when people are presenting, because obviously the topic is massive. We could spend 12, 13 weeks teaching on these modules, for example.
Yeah.
So it's just the curiosity, like, okay, what about green funds? Okay, which sectors start with something basic? Which sectors are at risk? Which sectors are more proactive? Do you have to work with governments at the local level, national level? These are the questions to start with. I think your slides had a lot of food there for those who are intellectually hungry and curious. Can we take a couple of more questions before we wrap up the session?
I'm happy to.
Anybody else here? George, I can see you're still there. Do you want to ask your colleagues? We've also got exec students. We've got Vishwant, Charan. I'm just looking at one page, so I don't have all the names. We've also got Vishal. Please shoot. Miss George, I can see you unmuted yourself. Go ahead if you want.
Oh, yes, I was going to ask about the fines that happen. We see that a lot of these firms are also fined as a result of maybe greenwashing and not even being ESG compliant. So the fines that the governments collect, I'm not sure if this is, if you have in-depth information about this, but it would be lovely if you do.
I like where this is going.
Do they actually help in fixing the issues, or is just being redirected into supporting some other part of industries that actually pollute the environment again? So we've seen Shell, BP, the large corporates, we've seen them being fined huge amounts of money in Australia, in the UK, in the US. But this doesn't, the society doesn't necessarily see the direct correlation of these massive fines and the reinvestment into sustainable living in the environment. So that was a question that has been,
That's an excellent remark, more than question. Yes, absolutely. There is more fines. I mean, I have to tell you that law firms are having now a very distinct litigation department on sustainability. So it used to be a time that was more of advisory work they used to give. And, myself, I'm a lawyer. So the law firms now are having a really distinct litigation department for environmental and sustainable matters. So that is growing, and that's obviously putting pressure on the companies. It's a very interesting point to say, well, are those fines really reinvesting in actually making the world a better place? The short answer is I don't think so. It should be. Some of the jurisdictions seem to actually start attaching that value, that purpose value into those fines, particularly in some countries like Brazil. But we are still far away from that. It is growing. Personally, sustainability-driven litigation can have two sides. One obviously is the enforcement, but on the other hand, I think it makes companies miss the whole point. So they become a kind of box ticking exercise more than, look, I'm going to compete to be the most sustainable, and then others will try to compete to be more sustainable than me. So it's an endless debate about rules or principles. I'm more of a principles person personally, because I do trust on responsible behavior as a driver of competitiveness. But you will have a lot of people disagreeing and saying, look, we need more regulation, we need more enforcement, otherwise nobody's going to do it out of their goodwill. So
that's really good. That's really good question, and really a suitable answer. I think the question is also quite market specific, because I've just shared two readings here. So the first one is talking about there's a push coming from certain industries in certain markets saying enough carrots, time for the stick. And another one that says from carrots to sticks, decarbonization's shift to penalties. Now the difference is, if we look at some of the G7 countries, essentially there's a push more towards the stick in different forms. Some sticks have failed. I think we can take quite a few examples there. Carbon credits, for example, so very debated still today, which is something you could look at. Carbon credits, don't have the time to get into that right now, but that's something worth looking at, investigating. But then if you look at the BRICS countries, the emerging, not just the BRICS, if you look at the Asian tigers, Singapore, Philippines, and the rest, there's a strong push for carrots, because the levels of understanding that certain societies still need before you can talk about carbon credits and carbon sequestration, the scope 3 emissions, and so on, you got to get the foundations right. So some of the emerging countries, there's a carrot, a low-hanging fruit carrot, so to speak. So this is a very market-specific question, and it's relevant because once you know which market you are going to function in, which industry you're going to be in, accordingly, you got to train yourself just to know where the carrots are. would they be box ticking exercise that Inma rightly pointed out, or it's a question of not earning the carrots, but how do I avoid getting the stick? That's not the same thing. Getting the stake and finding a way to avoid the stake, but not necessarily earning the credit. They're two separate stories, realities. So one takeaway would be, Inma, you might want to share a takeaway from the lesson, but one thing I would like to point out is choose your industry, focus on a market, try to find out as much as possible about that particular market within and that particular industry that you're interested in, airlines, finance, food and beverage, edtech, AI, whatsoever it might be. Find out everything possible about that market, because that's going to be your expertise, geographic expertise and market expertise. There are markets that you know a lot about, which is great. That's a starting point. Add an extra geographic focus, add an extra geographic regional expertise about this market. So you know the information at your fingertips. You may not be able to know everything, but know the necessary bits. It really helps conversations to go forward. That's what we need. Again, I mean, when you meet in prime conferences and so on, and you host quite a few on your campus. Last year, we had a fantastic one. It's really pushing the discussion and the conversations to the next stage and the level, next layer of conversation. So that's really beneficial. But if there is any takeaway that you'd like to suggest our student to leave with?
I mean, for me, it was really to highlight the role of the financial sector in sustainability, whereas we normally are much more aware of, the chocolate we buy, the clothes we buy, the food we buy, food waste. When it's the time of choosing our bank, we don't really think on sustainability aspects. So hopefully I've created some awareness of really the influencers of sustainability, as I like to call them, banks and big investors, and create that notion of how they actually contribute or contradict sustainability when they lend or when they invest in companies. So that's really my main takeaway, and I hope that's opens some questions, inquiry, intrigue, curiosity to that.
Fantastic. Thank you once again, Inma. Thank you for
you.
your time, sharing your expertise. And it's always good to hear from you, because there's lots of examples every time you present. I've seen in the past as well. I hope
Thank
the
you
next
very much.
talk will be on nature impact, which you slightly sort of loosely mentioned one. That could be the next talk. We would love to know more about nature impact and science-based targets and newer concepts that are coming out.
Absolutely.
George, anything you'd like to add before we wrap up the session as a co-host?
Oh yeah, Imad, thank you so much. It's the session came at the right time because it really a lot of us, given what we have recently learned, this really helps to drive it home and would help us in in future sustainable investment and understanding the correlation between profitability and sustainable investment. So thank you so much. We're looking forward to hearing from you again. And as always,
thank you very much.
Wonderful.
Rick, I'm quite happy to share the slides if you want me to send
that
them
would be
to
great,
you.
actually.
I mean, if it can be any help to
Absolutely.
maybe I dropped some words there, some technical concepts. Some people might like to.
That would be really appreciated. You can email me afterwards,
yes,
and I can share
I will.
I can share that with the cohort. Fantastic. Okay. Well, thank you, everybody who joined us today. Listen to us attentively. If you do have some thoughts afterwards, email me. I can forward that to Inma, and we can continue the conversation, because that's what you're having here. This is not a guest lecture as such. It is a conversation. It was quite engaging, and I appreciate all the engagement, therefore. Okay, well, have a lovely rest of the afternoon and the week. Take care. Thanks. Bye.
Thank you very much. Thank you very much for having me. Bye-bye.
Bye.
9205. Thank you. It's 9400, so it doesn't recommend.